Hello, I'm Peter Herbert and welcome to this month's short CPD webinar in which we explore topical issues affecting accounting, auditing and company law. And this month's session is called Fred 82, What's It All About? For those that watched the December 22 session, we were looking forward to things that were going to hit the street in 2023. And this actually was published just before the end of the previous calendar year. This is the exposure draft amendments to IFRS 102 that we think will come into play from periods commencing 1 Jan 2025, effectively what we're calling the periodic review. What we're going to do in today's short session is highlight some of the key things which are being proposed in terms of change, what that will mean for accounts, and what firms and companies should be doing next. Okay, so just a quick heads up on the timeline. We are expecting this revised IFRS 102 standard to take effect from periods commencing 1 Jan 2025, so effectively 31 December 25 year ends. There will be changes as well to the other suite of IFRSs, including IFRS 105, and we'll talk a bit about that during this short session today. But yes, the exposure draft amendments issued in December of last year, comments required by April 30th of 2023, we're then expecting as final standard in the autumn of 2023, giving companies good time to prepare in advance of that implementation date of periods commencing 1 Jan 25. And there it is, Fred 82. So you can get access to the standard or the exposure draft standard on the FRC website. There's also a short webinar which they've actually recorded discussing the key aspects of the changes. There are within the consultation document a number of questions which they want people to actually comment on in terms of actually what people's views are in relation to the changes. As I say, April 30th, 2023 is the deadline for those comments. So do get onto the FRC website, have a look at the detail. And if you do have comments about what you like and don't like, do feed those in obviously to the FRC to help inform the final version of the standard to be published, we think, in the autumn of this year. Now, when we were talking about this in our session last year, we were commenting on the fact that there were three big IFRS changes that would, to a degree, we thought, inform the periodic review changes and therefore effectively Fred 82. And they were changes in relation to IFRS 9. Now, IFRS 9's key change in terms of the way we actually account for financial instruments is all about loan loss provisioning, bad debt provisioning, and moving away from what we would call an incurred loss approach of provisioning and more to an expected loss provisioning approach, which is slightly more prudent. And I guess the million-dollar question in terms of the way that Fred 82 would embrace the IFRS 9 principles is, would it actually bring in the expected loss approach or would it not? We have recently had the exposure draft amendments to the IFRS for SMEs, which of course is always in the mind of the FRC when they're actually thinking about changes to UK GAAP. And interestingly, in the IFRS for SMEs exposure draft proposals, they chose not to embrace the expected credit loss model in terms of the way the provisioning would actually work. Revenue recognition, yes, this is actually moving away from the current approach to a different approach to revenue recognition, where we have currently, I suppose, certain categories of income that are accounted for in particular ways. What IFRS 15 effectively brought in, and as it says, it does align to a greater extent with US GAAP, is a standard 5-step approach for determining when and how revenue should be recognised that would apply to all revenue streams. That's very much embraced within the exposure draft revisions to the IFRS for SMEs. Interesting to see, therefore, whether and how the FRC embrace that within their proposals for IFRS 102 and IFRS 105 as well. And then the lease contracts change, of course, that's the big one, where from a lessee point of view, we do bring most operating leases kind of on balance sheet. Big impact there at an IFRS level when IFRS 16 came out 2 or 3 years ago. The IASB not advocating that be embraced at an IFRS for SMEs level in relation to the recent exposure draft. So the million-dollar question would be whether and how the FRC would embrace the IFRS 16 principles in shaping IFRS 102 and IFRS 105 in terms of the periodic review. So that's where we were. And actually what we've ended up with in terms of the plan from an IFRS 102 point of view in relation to FRED 82 is that both from an IFRS 102 and 105 point of view, the IFRS 9 proposals alongside or in line with the IFRS for SME proposals are not being adopted. That's not on the agenda, certainly based on the exposure draft. So that's a no. IFRS 15, yes, at a 102 and 105 level. FRED 82 advocates moving away from the current approach and towards this sort of 5-step approach for determining income in all cases. And interestingly, from an IFRS 16 point of view in terms of leasing, what they're advocating is that we do indeed embrace the IFRS 16 model in an IFRS 102 world, but we don't embrace it in an IFRS 105 world. I guess the idea being that with an IFRS 105 world, micro entities, it's all about keeping accounting really simple. And therefore, perhaps from an IFRS 105 point of view, bringing our leases on balance sheet is really perhaps a little bit step too far, certainly at the current time. So that's what they've advocated. And those, I suppose, really are the fundamentals of what we've got within the periodic review proposals. But that's how it's kind of shaped up in relation to what they put forward in FRED 82. Okay, so let's just talk a little bit more about one or two of those aspects. So the new leasing approach, yes, from a lessee point of view, the new IFRS 102 approach will mean a single accounting model with no distinction made between op leases and finance leases. Now, there are some exceptions, there are some simplifications, which to a point, I suppose, are also embraced in IFRS 16 as well. But many organizations will have, at least some leases that are in scope here. And I think, therefore, that will be a very impactful change if it does become finalized off of the back of the consultation in relation to FRED 82 at the current time. From a lessor point of view, again, aligning with IFRS 16, we do still have the distinction between operating and finance leases. So it's very much a lessee thing, not so much of a lessor thing, but that's very much what IFRS 16 says. And that's what the revision to IFRS 102 will advocate as well. And what you fundamentally do for operating leases, I'm sure a lot of you will be familiar with the way this works, not least because many of you may well already be preparing or auditing accounts prepared under IFRS 16, is at the point of inception of a lease, you quite simply take future payments to the lessor, discount them back to net present value using the implicit rate in the lease. If that's not available, you can use the incremental borrowing rates of the lessee. That will then give you a discounted figure for the creditor, which you pop into the balance sheet, and then the corresponding debit then will become a right of use asset within fixed assets. Now, there's a little bit more to the detailed numbers than that, but that probably is broadly where we are in terms of the actual accounting treatment. And I guess, yeah, if you are looking at a situation where you perhaps got a property lease, which is maybe a 2 or 3 year lease, you're doing that net present value calculation, you're going to end up with a relatively low figure compared to the value of the asset in its entirety. But what you're not trying to value within assets in the context of IFRS 16 or these proposed amendments to IFRS 102 is the value of the asset itself, but the value of the right of the lessee to use the asset over the period during which the lease will be in place. It's a very interesting concept there, but I guess from my side, it's all about bringing the obligation on balance sheets. If we're going to bring the obligation on balance sheets, we've got to balance it somewhere, and where we balance it within the balance sheet is this right of use asset within fixed assets in the balance sheet of the company. In this situation, obviously now applying the revised IFRS 102. In terms of the simplification, so there are a few of them. So short-term leases of less than 1 year's duration, no need to do that net present value calculation there. So that's going to quite simply be in a short-term lease situation, throw the costs into the P&L as you currently would do from an operating lease perspective. Low value assets, this is where we've got, again, a similar sort of broad approach under the proposed IFRS 102 amendments to what we have under IFRS 16. The way that IFRS 16 embraces low value assets is to talk about a value at the point that the asset is kind of bought new of less than approximately $5,000 US. What the IFRS 102 amendments do instead with this area is they give you a list of the sorts of assets that would be deemed to be low value, a list of the sort of assets that would not be deemed to be low value, and they tackle it that way instead. And I guess from the point of view of ordinary common garden companies that will have leases, the two that would very much not be in scope per that list for being determined as being low value would be property assets and would be vehicles. So leased cars, leased vans, leased property, they would be in scope for the new treatment. And that's why I say, for so many companies, this will impact, obviously, to the extent that, number one, this does become definitive, and number two, the companies concerned do apply IFRS 102 in preparing their accounts day to day. Portfolio approach for leases with similar characteristics, so look at it in the round rather than looking at to granular level in terms of the individual leases. That, I suppose, makes sense. Separation of non-lease components. If we maybe are leasing property and we've got very much therefore an operating lease in play, but perhaps with that particular property that we're leasing, we've got the ability to tap into ancillary services, perhaps cleaning, security. I guess what you technically need to do from an IFRS 16 point of view is unpick the actual cost of the ancillary services from the cost of the rent and account for the rent following the principles here, and the ancillary services get expensed to P&L. What you can choose to do is look at it in the round, look at it as one entire contract, and not worry too much about unpicking those non-lease components when you're doing the lease accounting year per the revised, effectively section 20 of IFRS 102. And that's got a very similar sort of feel to it, really, to a similar simplification that you've got within IFRS 16 at an IFRS level. No requirement to restate comparative, so the ability to actually apply this from effectively 1 Jan 25, rather than going back to day one of the comparative period 1 Jan 24, which obviously therefore gives you a bit more time, I guess, to prepare. Similar sort of dispensation there in terms of bringing in the revenue recognition changes as well. And simplified rules when transitioning from IFRS 16. So if off the back of this, we have some companies moving away from IFRS and moving towards a UK GAAP IFRS 102 model, because of course the principle very much join up with IFRS 16, you can quite simply take your IFRS 16 numbers at the point that you do transition, pop those in, and you're good to go. That makes transitioning easier from IFRS to UK GAAP at the point that these revisions actually take shape. So some simplifications there, but for sure, this is going to be challenging. It is going to be impactful. It's not coming in yet. It's not even definitive yet, but certainly being aware of that coming down the line is quite important. And we'll cover that in more detail on our accounting update courses during the early part of 2023. The revenue recognition changes, I think, from my experience, having done lots of training on IFRS 15, when that came in at an IFRS level 2 or 3 years ago, I suspect will probably be impactful for some, but perhaps not quite as impactful as the leasing changes. What I always say about the IFRS 15 model to account for revenue is that under UK GAAP, as I mentioned in the intro, we've got different categories of income, typically in commonly goods and services and construction contracts, and each category is accounted for in its own different way. Sometimes I think it's not always clear which category you're in. And certainly in terms of certain property transactions, it's not to me always clear from a current UK GAAP point of view whether we're talking about sale of goods or whether we're talking about delivery on construction contracts. And depending on the actual category you end up in, that will impact clearly quite significantly on the way the accounting treatment works. What the IFRS 15 model will do and what the new UK GAAP model will do, it will do away completely with that slightly grey distinction between different categories of income and say, here are 5 steps we've got to follow through every single time to work out when revenue is recognised and over what time scale. So I think although it's probably a bit more complex than the current section 23 of IFRS 102 on revenue, I think this probably is a change for the better. As I've said on a number of courses in recent years, I think section 23, given that revenue obviously is such a massive figure in the balance sheet for so many companies, is a bit light on detail. And I think therefore this will be probably a revision for the better at the point it comes in, if indeed it does. And there are effectively the 5 steps. And we're not going to go into all those steps today. It's a short session. One I would just flag up as well here, identifying the promises in the contract. It works really well, I think, there's this particular approach where you perhaps got bundles of products and services being sold all at the same time, and maybe you get a discount for buying the bundle rather than buying them individually. Lots of good detail within IFRS 15 and therefore the revised 102 about how you might apportion that discount across the different elements in the bundle. So I think it will be a challenge for some, but I think definitely a change for the better. And that, of course, it does apply across the piece from an IFRS 102 and an IFRS 105 point of view as well. Okay, so that's the 2 key bits. There's not a huge amount else, actually, having been through the exposure draft end to end, a few little bits and pieces. So some tightening up small entity disclosure. The section 1A regime, of course, is one, isn't it, where currently it's very much based on the EU accounting directive. And we have not been able to, at a UK GAAP level, impose on small entities any more disclosure than what's actually required by that directive. And where the FRC thought it was appropriate to encourage small companies to disclose more than what the EU directive mandates, all we could really do was to encourage within effectively what was and what has been Appendix E to Section 1A. Off the back of Brexit, that obligation to be very much tied to the directive's requirements and no more, and an inability, if you like, to gold plate kind of gone away. And that list of Appendix E recommended disclosures therefore drops out. And there are some things which the FRC is saying now that you would need to disclose in a small company, so that you wouldn't technically need to have disclosed under the current regime. Specifically around going concern is one that caught my eye, and some specific stuff around provisions for liabilities, where currently technically you can disclose nothing. That's obviously quite an interesting figure from the reader's point of view, and there's more specifics there in relation to the requirement for disclosure as far as that is concerned. So that's an interesting tightening up around small entity disclosure based on Section 1A of IFRS 102. There is a rewrite of the concepts and principles chapter to align with the IASB's principles framework from 2018. Interesting, complete rewrite. I'm not sure it'll have a massive difference day to day. A complete rewrite of the fair value section within, I think it's chapter 2 of 102, aligning to the IFRS 13 model within IFRS. And that may mean that in some situations we do determine fair value differently under the new version compared to the old version. I don't think it'll make a massive difference lots of the time, but there might be some slight tweaking of fair value to affect the way that IFRS 13 embraces that, perhaps compared to what we've currently got within IFRS 102. Within the section looking at accounting policy disclosures, quite a big push towards disclosing accounting policies that are material and not disclosing those that are not. That's, I think, quite a big theme from the FRC currently, the perception that perhaps accounts very often get cluttered with accounting policy disclosures that aren't really needed. That, to me, seems to be quite a big theme, and some specific changes and clarification as well in Section 19 in relation to business combinations, but not a lot else there really other than the leasing and revenue recognition changes. Things that I think I commented on in the December 22 session that I thought might get embraced, possibly some specifics around the accounting of some of the current environmental issues that we're facing, possibly some change around share-based payment, maybe making it easier for small companies applying 1A, possibly some specific granular detail around website development costs and intangibles, and possibly some clarity around accounting treatment for cryptocurrency investments. None of that's included. So I think in reality, there's perhaps not quite as much as we thought, but what there is there around leasing and revenue recognition is really impactful and does therefore, I think, require quite a lot of reflection as this comes in a couple of years' time. So I don't know. I wonder whether maybe there might be some scope for some organizations to contemplate changing regime off the back of this, certainly in relation to the leasing changes. If bringing op leases on balance sheet does not appeal, are there companies that are currently applying 102 that might want to go down the 105 route instead? Might it flip the other way around, whereby if you are actually wanting to account for all leases in the same way across all your client organizations, might you find some firms moving their IFRS 105 clients onto IFRS 102? Possibly. Maybe you've got some organizations currently that are embracing IFRS rather than IFRS 102, possibly in a group situation, to ensure that from a group perspective, all leases are accounted for in the same way. Now that IFRS 102 embraces the IFRS 16 methodology, assuming that it will, might those companies now go back onto IFRS 102? Might it be that because IFRS 102 actually in this particular area of leasing is no different to IFRS now, we have perhaps got an IFRS group, you get no real simplification from accounting treatment for leases at an IFRS 102 level in terms of having that off-balance sheet presentation. Might you find some companies, therefore, moving the other way from IFRS 102 to IFRS? There are probably a smaller number of specific changes within the revisions proposed than perhaps there were from the point of view of the triennial review a few years ago in 2019. But the changes in those areas that are coming in around leasing and revenue recognition are complete revolutions, as it were. And it might be that off the back of this revision, we get more companies changing regime than was the case when the triennial amendments came in, effective for periods commencing 1 Jan 19. So lots of food for thought there. That gives you an overview. As I say, we will be covering that in more depth on our accounting update all through the spring. As I say, do look at the FRC website for more resource. Do be willing to feed into the consultation. And as I mentioned, that actually closes on April 30th of this year. Okay, hope that was useful. Any questions or queries about the session, do obviously drop us an email, inquiries@insight-training.co.uk. And for our full suite of programme courses for spring, summer and autumn 2023, do jump onto our website, www.insight-training.co.uk, and all the information you need there about our courses for this year. Hope that was useful. Thanks for listening, and I'll speak to you all again soon. Goodbye.